Guys, we're about to witness the largest wealth transfer in American history. It's not a crash. It's not a bailout. It is a flood. 4.7 trillion is about to pour into the US economy in the next 9 months, and 90% of investors have absolutely no idea it's coming. So in today's video, we're going to break down exactly what you need to know and how you can use this to your advantage, because there's going to be a lot of people that this becomes a shock for, people that are going to be left behind. And then there's going to be a lot of people that were prepared for this, people that are going to benefit massive. We're going to break all this down for you with the timestamps down below. And the only thing I ask in return for all the work that goes into making a video like this is that you hit this like button and don't forget to subscribe. Every time you do that, YouTube goes and it pushes this video out to more people, which helps us prepare more people for this incredible year. And if you want access to our full research and daily stock ideas, you can try our premium community for just $25 at stockscommunity.com. Plus, if you want to get the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com in the description below. As always, if you're the one making the actual purchases, the sells, you have to do your own diligence as well. Take your time, be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now, let's get into it. Wall Street knows about this. The current administration's plan isn't just policy, it's a market catalyst that'll create millionaires and destroy portfolios that aren't positioned correctly. And I'm going to show you the exact timeline, the 5 waves of capital flow, and why one specific semiconductor stock is positioned to capture more of this flood than almost any other company. But here's the catch. The window closes fast. So let's break this down step by step. Here's what most people miss. The 2025 tax cuts, the big beautiful bill, and the Jobs Act 2.0, it wasn't just about lower interest rate. It's about timing. The bill passed in March 25, but the impact hits in 3 massive waves. Wave number 1 is April to June 2026. Tax refunds. They're pulling it forward this year. It's going to start at the end of February, the earliest ever in history. Wave number 2, July to September, that's corporate repatriation. I'll break that down for you in a moment. And then wave number 3 is the 4th quarter of this year, and that's all about bonus depreciation and capital expenditure. Let me explain why this matters. According to the Congressional Budget Office and Treasury estimates, individuals will get $1.2 trillion in tax refund. That's $8,500 per household. Corporations will get $2.1 trillion in corporate cash repatriation from overseas, and $1.4 trillion in accelerated depreciation and business investment. So the total flowing into the economy is a whopping, staggering, mind-boggling $4.7 trillion in just 9 months. For context, that is 3 times the size of the 2008 bank bailout. The COVID package was half the size of this. This is literally 20% of the US economy hitting the market in just 9 months. We've seen this before, just not at quite this scale. The 2017 tax cuts, what happened? Well, what happened to the market is the S&P rallied by 28% in the next 18 months, but that was only $1.5 trillion. So for $1.5 trillion, you get 28% up. This is 3 times larger. The Bush tax cuts, that was when small cap particularly benefited. Small caps went up 47%. Real estate investment trusts went up 38%. If we go back a little further to 1981, the Reagan tax cuts, back then it was the Dow Jones Index. It went up a whopping 135% over the next 5 years. But here's the difference, the critical difference in 2026. We have record low unemployment. We have a Fed that's already cutting rates. We have pent-up consumer demand. This isn't a recovery, it's rocket fuel on an already pretty hot economy. And if you go back to the COVID stimulus era, there were some clear parallels here. In March 2020, the CARES Act handed out $1,200 per adult. December 2020, another $600. March 2021, the American Rescue Plan added $1,400 per person. So the total COVID stimulus in that first round was about $814 billion. So what happened to tech stocks? after that. The most explosive rally in history. The NASDAQ surged 49% in 2020 alone, another 28% in 2021. That's 76% gains in the overall index in just 2 years. The FANG stock, back then it wasn't the terminology, that they absolutely exploded. But Apple was up 82%, Amazon up 79%, Tesla 394%, and Nvidia 87%. And the data that Wall Street doesn't want you to know, research shows that of the $814 billion distributed in the first round of COVID stimulus, $100 billion went directly into the stock market. $100 billion. And that's just directly. If you look at indirect investments, it's probably way more. Now, this isn't a coincidence. There's a direct causal link here. So think about that, and then think about what's coming. We're looking at potentially $500 billion worth of refunds coming in the next few months. Now, let me explain the mechanism behind this, because few people understand this. Few people are even aware that this is a thing. So when the One Big Beautiful Act was signed on July 4th of last year, it included massive tax cuts that were retroactive to the entire 2025 year. It was retroactive, but here's the thing, the IRS never adjusted the payroll withholding tables after the bill passed. So what does that mean in plain English? It means that every American worker has been overpaying their taxes all year. And so when the refunds come, a lot of people don't even know to expect this, because their taxes got cut retroactively for that entire year, and employers kept withholding at the old higher tax rate. So for a lot of people, they're going to get a bigger refund than they were expecting. And when people file their returns, the IRS has to give them all that money back. It's a massive lump sum. So this isn't stimulus. This is people's money coming back to them. But it's going to have the same effect as stimulus. There are 7 major provisions that are going to create this massive refund wave. Number 1, the standard deduction increased by $750 for singles, $1,500 for couples. Number 2, the child tax credit jumped by $200, now permanently set at $2,200. It was supposed to drop back to $1,000 in 2026 under the old law. Instead, it's going up. Number 3, the SALT cap, state and local deductions. This was raised to $30,000 for people earning less than $500,000. That's huge for anyone living in California, New York, New Jersey, or any high income tax state. It's also huge for people living in Texas, where there's high property tax. Number 4, seniors 65 and older get a brand new $6,000 additional deduction if you're married and both qualify. That's $12,000. Number 5, auto loan interest is now deductible, up to $10,000 per year through 2028. This is designed to stimulate vehicle purchases. And number 6, no tax on tips. Workers can now deduct up to $25,000 in tip income. Number 7, no tax on overtime. Up to $125,000 in overtime pay can be deducted. Doubles up for couples. So remember, none of these provisions were reflected in paychecks this year. Employers still withhold all this money. So when folks go to actually file their tax returns, what's going to happen? Well, they're going to have a much bigger refund than they expected. So why will most investors miss this opportunity? Most investors are conditioned to react, not anticipate. By the time CNBC is talking about the tax refund rally, the easy money is already made. The smart money is positioning now in early 2026 before the refund checks hit bank account. Now, let's get tactical here. This $4.7 trillion doesn't hit all at once. It flows in 5 distinct waves, and each wave creates different opportunity. You miss one, you leave money on the table. Wave number 1, this is where we are right now. The bill is law, but the money hasn't moved yet. Smart institutional investors are looking to front run the refund season. So what are we looking at? We're looking at defensive sectors starting to weaken. So what are defensive sectors? Utilities, consumer staples, growth stocks, and small caps begin to outperform. And volatility, the VIX, the fear index, it drops as uncertainty clears. So in late 2016, before the tax cuts came in, small caps went up 15%, large caps only did 6%. Russell outperformed the S&P by 9 percentage points in just 3 months. Wave number 2, this is the real refund flood. And like I told you, it's going to come earlier this year. They're going to start this late February, earliest ever in the history of all history. So this is the big one. This is 1.2 trillion that hits consumer bank account. The average household is going to get a whopping $8,400. So where does the money go? Based on IRS data, 35% goes to debt repayment, credit cards, auto loans, 25% goes to discretionary spending, think vacations, home improvement, electronics, 20% goes to savings and investment accounts. So the last 20% is just rent, utilities, groceries. So what happens? Well, retail stocks love it. Think Amazon, Walmart, Target, travel and leisure companies, airlines, hotels, cruise liners. Brokerage firms love it. Robinhood, Fidelity, because more money goes into those brokerages. And the 2008 Bush stimulus check caused a 12% spike in retail sales in the month they were distributed. So this is 7 times bigger. Wave number 3 is corporate repatriation. So the tax bill includes a one-time repatriation holiday. Corporations can bring overseas cash back to the U.S. at a reduced tax. So we're talking about $2.1 trillion held by U.S. companies in foreign accounts. So why do they do that? They don't want to pay US tax on it. Apple, Microsoft, Google, they're all holding money overseas. So who benefits from this? The tech giants, Apple, Microsoft, Google. They hold more than $500 billion overseas. And the pharmaceutical companies, Pfizer, Johnson & Johnson, Merck, the industrial conglomerates, GE, Honeywell. What do they do when they repatriate this cash? I'll tell you what they're going to do with it. 40% is going to go into share buybacks, which basically reduces the number of shares out there, which means the remaining shares go up in price. 30% goes to dividends, 20% goes to mergers and acquisitions, and 10% goes to actual investment and capital expenditure. So tech stocks will probably rally pretty hard. The dividend aristocrats like Johnson & Johnson, Coca-Cola, they should outperform. M&A activity begins, which means investment banks benefit. The last time we had a repatriation holiday was in 2004. How much was brought home? $312 billion in 2004. So how much did the S&P go up that year? 15%. Tech stocks were up 22%. This repatriation holiday is 7 times bigger than the previous one. Wave number 4 is the bonus depreciation for business equipment and infrastructure. What does it mean? It means companies can write off the full cost of investments immediately, not over years. It's a massive incentive to spend now. So who benefits? Industrial, Caterpillar, Deere & Company, 3M, construction company, infrastructure, technology, Cisco, Oracle, Salesforce. Energy and utility companies, solar, wind, grid modernization. We're expecting $1.4 trillion in business capital expenditure. A lot of that will go into automation, AI, energy, and bring supply chains back to the US. In 2017, business investment grew 6%. Industrial stocks went up 34%. Now, here's where this gets really interesting for one specific stock. You have to understand that this hyperscaler capital expenditure is approaching $600 billion in 2026. Goldman Sachs projected $1.15 trillion from 2025 to 2027. AI infrastructure spending is contributing more to GDP growth than all consumer spending combined. Data centers, semiconductor, servers, cooling systems, energy providers for data centers. Massive opportunity. And an executive order was signed to make it easier to build data centers in the United States. Now, after years of high interest rates crashing certain parts of the market, the Fed has shifted very aggressively into cutting mode. Consensus is calling for 3 more cuts in 2026. The current Fed officials are trying to tease and say, no, we'll only do 1 cut, but that's just not what markets think. And whoever the Fed chair is that gets appointed in May is going to push for more cuts. There's been open criticism about rates being too high. The target mentioned has been around 1%. If we even get close to that 1%, you won't even believe what kind of melt up we're going to be headed for. But why does this matter for stocks? Lower rates, reduced borrowing costs for companies, makes it cheaper to finance growth, makes acquisitions easier and more common. Lower rates make stocks more attractive compared to bonds. When you can only get 3% from treasuries instead of 5%, growth stocks start looking a lot more appealing, especially if they can return 10 to 20% a year, like a lot of the AI stocks did in 2025. And lower rates mean higher valuations are justified. When you discount future cash flows at a lower rate, present values go up. That's just how the math works. So something that you might say is really overvalued in a high interest rate environment could be fairly valued or even undervalued in a much lower interest rate environment. And consider that we just came off the highest, fastest rate hike in like 40 years. That can make a big difference. Now, let's talk about the one stock that is uniquely positioned to benefit from every single wave of this $4.7 trillion flood. Taiwan Semiconductor Manufacturing Company, ticker symbol TSM. And I'm going to show you exactly why this is one of the most compelling opportunities in the market right now. First, let's talk about their recent earnings because they were absolutely incredible. TSM just reported Q4 2024 earnings that crushed expectations. It's 2025, obviously, but revenue came at $6.3 billion. It's up 40% year over year. Net income was $11.4 billion. That's up 60% year over year. Gross margin expanded to 60%. That's up from 55% a year ago. Operating margins hit 49%. Oh, think about all that for a second. A manufacturing company with nearly 50% operating margins, that's unheard of. For the full year, TSM delivered revenue of $86.2 billion, up 30% year over year. Net income of $36.4 billion, up 40% year over year. Here's what's even more impressive. Their guidance for Q1, they're projecting revenue between $26.1 and $26.9 billion. That's another 30% growth year over year. And for the full year, management is guiding for revenue growth in the mid to high 20% range. For semiconductor manufacturing, it's a capital intensive business. Growing at 25% plus is incredible. They're the sole supplier of the most advanced chips in the world. And let me explain why TSM is positioned at the absolute center of this $4.7 trillion flood. Number one, they're the exclusive manufacturer of NVIDIA's chips. Every single NVIDIA H100, H200, and Blackwell chip is made by TSM. NVIDIA's data center revenue was over $100 billion. Every dollar of that revenue required TSM chips. Number two, they manufacture for AMD. AMD's MI300 AI accelerators are all made possible by TSM. AMD is seeing explosive growth. They're a more economical choice in many cases. And all of that flows through TSM. Number three, they manufacture for Apple. Every iPhone, every Mac, with an M series chip, every iPad, all TSM. Apple's sitting on over $200 billion in overseas cash. So when that repatriation wave hits, what do you think Apple does? They buy back stock, they pay dividend, and they design more chip, all manufactured by TSM. Number four, they manufacture for Qualcomm, Broadcom, Marvell, AMD, and basically every fabless semiconductor company in the world. Number five, they're the only company in the world that can manufacture 3 nanometer chips at scale, and they're on track to start 2 nanometer production in 2026. Nobody else can do this, not Intel, not Samsung, nobody. Now, remember, I mentioned American state capitalism. The government is coming and buying up stocks, and they're picking the winners, basically. Last year, they invested billions of dollars to buy about 10% of Intel. Why? Because the government wants to help Intel compete against China in semiconductor manufacturing. But here's the thing, TSM is already miles ahead of Intel, and the US government knows it. TSM is building 3 massive fabrication plants in Arizona. Total investment, $40 billion. US government is providing subsidies and support for this because they need TSM's advanced manufacturing on US soil. So this is a national security priority. When you combine government support, the AI boom, the capital expenditure wave, corporate repatriation, and consumer spending, all flowing into technology, TSM is positioned at the center of all of it. Now, let's talk valuation. TSM is currently trading at about 23 times forward earnings. For a company growing revenue at 25% plus with 60% gross margins, 50% operating margins, with monopoly on the advanced semiconductor manufacturing in the world, with every major tech company as a customer. That's cheap. NVIDIA trades at 35 times forward earnings. Apple trades at 30 times forward earnings. TSM at 23 times is a bargain, especially when you consider what's coming. So let me walk you through how TSM benefits from each wave of this $4.7 trillion flood. Wave 1, front-running the refund. Growth stocks and tech stocks outperform. TSM is a growth stock with a tech multiple. It rallies. Wave 2, The refund flood. Consumers get $8,500 on average. Where does that money go? 25% to discretionary spending. What do they buy? New iPhones, new laptop, new electronic, all powered by TSM chips. 20% goes to savings and brokerages. So what do retail investors buy? The stocks they know. Apple, Nvidia, AMD, all TSM customers. The stock prices of TSM's customers go up, which drives more orders to TSM. Wave 3 corporate repatriation. Apple brings home $200 billion. Microsoft brings home $100 billion. Google brings home $50 billion. What do they do? 40% goes to buybacks, 30% to dividends, 10% to investment. All this is bullish for their stock prices and for their chip order. More demand for TSM. Wave 4, capital expenditure boom. $1.4 trillion in business investment. Where does that go? AI infrastructure, data centers, automation, cloud computing, all of which require chips, all manufactured by TSM. Wave 5, ongoing AI infrastructure spend. Hyperscalers are spending $600 billion in 2026, $1.15 trillion through 2027. All of that requires the most advanced chip, all manufactured by TSM. You see the pattern here? Every single wave of this $4.7 trillion flood flows through TSM. Now, let me be clear about the risks because I want you to go into this with eyes wide open. Risk number 1, geopolitical risk. With China and Taiwan, this is real. This is the biggest risk to TSM. If there's a conflict, TSM's facilities in Taiwan could be at risk. However, the US government is acutely aware of this, which is why they're subsidizing TSM's Arizona fabs. And frankly, any conflict would be so catastrophic for the global economy that all stocks would crash, not just TSM. Risk number 2, competition from Intel and Samsung. Intel is trying to catch up with their 18A process nodes. Samsung is trying with their 3 nanometer process. But TSM has a multi-year lead. And in semiconductors, being first with the most advanced process is everything. Risk number 3, cyclicality. Semiconductors are cyclical. When there's a downturn, it hits hard. However, with AI driving structural demand, we're in a super cycle. This isn't normal cyclicality. Risk number 4, valuation. If the stock runs too far too fast, there could be a pullback. But at 23 times forward earnings for this quality of business, there's plenty of room to run. So here's how I'm thinking about the timeline for TSM. Q1 2026, now through March, we're in wave 1, front running. TSM should benefit as growth in tech stocks outperform. This is accumulation phase. Q2 2026, April through June, the refund flood hits, consumer spending surges, electronics purchases spike, brokerage accounts inflows drive tech stocks buying. TSM's customers see strong demand. TSM rally. Q3 2026, July through September. Companies repatriate money. Apple, Microsoft, Google, they bring cash home. Buybacks and dividends flow. Tech stocks rally hard. TSM is a major beneficiary. Q4, October through December, capital expenditure boom. Businesses invest $1.4 trillion. AI infrastructure spending accelerates. TSM sees orders surge. Throughout all this, the Fed is cutting rates, making tech stocks more attractive, making future cash flows worth more, making TSM's valuation expansion justified. Now, I'm not telling you to go out and blindly buy TSM. You need to do your own research. You need to make your own decisions. But here's how I'm thinking about position. If you're conservative, dollar cost averaging over the next few months is reasonable. Take a position, add on any dips. If you're more aggressive, build a larger position right now before the refund wave hits. And if you're very aggressive, considering call options for Q3 or Q4 expiration would be an idea to capture that repatriation and capex wave. But regardless of your risk tolerance, TSM deserves to be on your radar because when $4.7 trillion flows into the economy and a huge chunk of that flows into AI infrastructure, semiconductors, and technology, it all flows through TSM. Now, I need to address one more thing. $4.7 trillion flooding into the economy will cause inflation, just like when the Fed printed $4 trillion during COVID. The Fed is going to respond eventually. In a normal environment, they would hike interest rate, but we're going to get rate cuts in 2026 first. Why? Because that's what the current administration want. But after the midterms, if inflation accelerates back up to 3%, we could see rate hikes in 2027. That's when you want to have a risk management plan. Energy stocks went up 65% in the 2021 and 2022 inflation surge. Tech stocks down 35%. So you want to set some sort of risk management whereby you take profits on high valuation growth stocks if inflation comes back. But that's a 2027 problem. For 2026, the setup is bullish. The real measure of inflation isn't what you pay for groceries or gas and the economy, it's the stock market. And if the stock market goes up 25%, that's 25% inflation in asset prices. So your salary didn't go up 25%, but people who own stocks, real estate, gold, silver, other hard assets, they got 25% wealthier, which means if you're not in assets, you're getting 25% poorer in relative terms. So what does that mean? Put as many dollars into assets as you can. That's the only logical conclusion. Now, could something go wrong? Yes. Fed, could appoint a Fed chair who turns around and does his own thing. We've seen that before. Consumers could decide not to spend any of their refund money. They could save it because they're scared about the future, scared that AI is going to make them possibly unemployed. That's possible. But if they save, the money just flows to different places. It flows into brokerage accounts, into Robinhood, into Schwab. That still props up the market. And what do consumers buy when they get these brokerage accounts open? They buy stocks. So, they buy stocks they've heard of, the popular ones: Apple, Nvidia, Microsoft, Amazon, Tesla. They're all TSM customers. You could also argue this is already priced in, but I don't buy it, because when I talk to people outside of Wall Street, they look at me and they go, what? This is happening? So you're way better informed than 99% of people out there. So let me bring all this together. We're about to see $4.7 trillion flow into the US economy in 9 months. That's 3 times the size of the 2008 bailout, twice the size of the COVID stimulus. It's happening in 5 waves: tax refunds, corporate repatriation, capital expenditure, and ongoing AI infrastructure spending. Historical precedent shows us that when that much money flows into the system, tech stocks rally hard. In the 2017 tax cuts with $1.5 trillion, the S&P went up 28%. This is 3 times larger. During COVID with $814 billion, the NASDAQ went up 76% in 2 years. This is almost 6 times larger. And sitting at the center of all this is Taiwan Semiconductor Manufacturing Company. They manufacture chips for Nvidia, AMD, Apple, Qualcomm, Broadcom, and every other major tech company. They have a monopoly on the most advanced chip manufacturing in the world. They just reported 38% revenue growth and 57% earnings growth. They're guiding for another 25% plus growth in 2026. They trade at 23 times forward earnings, and they're positioned to capture demand from every single wave of this $4.7 trillion flood. Consumer spending on electronics, TSM benefits. Corporate repatriation on driving tech stock buybacks, TSM benefits. Capital expenditure flowing into AI infrastructure, TSM benefits. Lower interest rates making tech stocks more attractive, TSM benefits. Government support for a domestic chip manufacturer, TSM benefits. This is one of the most compelling setups I've seen in years. Now, look, I'm not your financial advisor. I'm not a financial advisor. This isn't financial advice. You need to do your own research. You need to make your own decision based on your own risk tolerance and financial situation. But if you're looking for a way to position for this $4.7 trillion wave, TSM deserves to be at the top of your list. The smart money is positioning now in early 2026 before the refund checks hit bank accounts. Don't be the person who watches from the sidelines while others multiply their wealth. And if you want access to our daily stock ideas, our trade alerts, and our full research reports, you can try our premium community for just $25 at stockscommunity.com. We break down setups like this every single day. Plus, if you want the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com. The link is in the description below. So what are your thoughts on TSM? What are your favorite stocks for 2026? What are your predictions for how this $4.7 trillion wave plays out? Let me know in the comments. I love hearing from you. But that caps off today's video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it, because the window is closing. The opportunity is now, and the people who position correctly are going to make life-changing money in 2026.